maybe you could talk to us a little bit more. We talked about how you were differentiated and that really being why New York Life selected you amongst 16 other firms to really do their self-storage development and partnership. And of course, the long-standing relationship you have with Protective Life. So can you go into more detail about that? What is it that makes Leitbox different?
Absolutely. And Sly, I appreciate the question. I'm grateful for the question. I do think that, the differentiated nature of our strategy is proven out by a New York Life or a Protective Life. But without a doubt, you need to kind of understand it. And I think the best way I can describe it is that so much of what we've done in self-storage harkens back to what we used to do in the retail shopping center business, right? And the first part is big data, harnessing big data to determine where we want to put a self-storage unit is hugely important. And is I think a technological separator, if you will, for us in the marketplace. And Sly, we were doing big data, if you will, and web scraping this information back in 2016, so much earlier than AI and all the new rage, right? But the reason was not because we're anything special. It was because the retailers that we were doing business with, they're special in terms of their data analytics. We like to say down in the Southeast, right, nobody's ever seen a Chick-fil-A that's closed. Right? These guys are fantastic at data analytics and demographic analysis. However, they all do it differently. Talbot's has a demographic criteria that's totally different than a Lululemon, that's totally different than an Anthropologie, that's totally different than an Ulta, you name it. And so in our world, we were so used to having to really carve out incredible demographic information to get that retailer to commit to our space. We took that to self-storage and said, all right, what creates an A-plus location? Well, we know it's a winner. And what we did is we created the population density. We want to be running about 300% more than the typical self-storage operator. Apartment dwellers, we want 40% of the trade area to be apartment dwellers. The key there, Sly, though, is we don't want it to just be an apartment dweller. We want that 2-bedroom to be renting for about $1,850 a month. Population growth, another one, we want that to be about 300% of the national average, which is about 0.07%, and then, 0.7%, and above average incomes. But we take all that data and stratify it, and it tells us, we call it Leitbox Site Finder. It tells us where we think that there's a supply and demand anomaly, where there's pent-up demand to lease a self-storage unit, and then we go. I think the best, again, data point to back up a strategy that we have, and as to whether or not we're all hat, no cattle, right? Whether or not we're all talk, no walk. In this case, the part that I think proves out, in my humble opinion, that our Leitbox Site Finder is working is that 50% of what we've sold at certificate of occupancy. And that in and of itself is an anomaly. That in and of itself is without a doubt rare air. And to explain it to you, that is certificate of occupancy is the day the building inspector comes out and cuts the yellow ribbon with you, right? You are officially licensed to open your building. Now in self-storage, because entitlement and zoning and things of that nature are so hard to secure, if you can go to a real unique location with a high barrier to entry format, meaning that it's really, really hard to get proper zoning, then you can sell at certificate of occupancy. When we got into the business, certificate of occupancy was something that was just kind of getting started. Now for us, it's really become such a big part of what we believe is a great mandate, in that it's an incredible return profile at a very low risk. Because think about it, you have not leased the first unit. You really haven't proven out your investment thesis. However, your location is so dominant that folks like SmartStop, CubeSmart, other institutional players that we've done business with buy your assets. And the number they buy them at, the last one we traded was in Eatontown, New Jersey. We had about, let's say, less than $10 million in the asset. We sold it to an institutional player for $20 million. So the returns on these certificate of occupancy opportunities are incredibly attractive. Now, the second part of kind of that retail DNA that we bring into self-storage was design prototypes. We like to say, you've never walked into a Dick's Sporting Goods that looks different. And the whole idea in retail is always to look at a rectangular box and think about how much sales activity can I generate out of this rectangular box. So that retail mindset is completely opposite of what we found in self-storage. The self-storage biggest players, CubeSmart, Life Storage, Extra Space, were all customized. Every one of their physical plants, if you think about owning $30 billion worth of real estate, and every single one of them has a different format, right? There's tremendous inefficiency in that. Retail, right, is all about efficiency and thinking about that physical plant, that rectangular box, as an ROI case, right? So in self-storage, well, we came back in 2016 after meeting with Extra Space, best-in-class player, without a doubt the gold standard in the industry. And Sly, you mentioned earlier that Target Grand Slam. So we had a good referral from Target going to see their senior leadership. And we said, where's your spec manual? And we're used to sitting down with Walmart that's got a 8-inch spec manual that tells you everything about what the locks look like, right, to the greatest of details, what color the light bulbs. And they said, we don't have a spec manual. Here's our office and our gate system, and that's it. So that was our aha moment. And so we came back and said, okay, we're going to create the Leitbox. And effectively, the Leitbox is a recurring physical plant that's got a unique, in my opinion, unique steel package and unique design to the unit mix. Disregard that, but it's a repeating process, a repeating prototype, and then we wrap the gingerbread around the outside to match the architectural symmetry of the area that we're in. So if we're in Washington, D.C. or Northern Virginia, we're doing red brick. If we're down in Florida, right, we're doing beige stucco most likely. But the blood and guts on the inside is still going to be that efficient light box. This slide, I think, demonstrates really the essence of what we've done with the Leitbox prototype we've built. So if you look in a building within the industry, there's dead space that's associated with elevators and exit stairwells and things of that nature where you don't have rental income you're generating from it. And in the industry, about 68% of your building is generating income. Well, at Leitbox, about 78% of our building is generating income. And that's the big difference. So if you can see the little green rectangle, that's the essence of what we're trying to do. By virtue of having a really, really unique steel package in terms of how we design the building, very, very simple, and how we do the unit mix layout across 3 floors, that allows us, just like a Walmart or a Target wants, to generate more sales activity, more rental activity out of a same finite amount of space as the industry. So that's the second part. And this is what some of the fruits of our labor looks like. As you can tell, probably which ones are in Florida, right? Which ones may be in Nashville, Tennessee. But that's what programmatic development looks like. Through programmatic, just like an assembly line process of Tesla cars, right? Duplication of process, repetition of process, all those things allow for an acceleration of speed and a reduction of risk. If you can't tell anything about the presentation today, just like with New York Life, anytime, right, you can improve your outcomes, i.e. the reward, and reduce your risk, i.e. programmatic development, that's always a winner in our mind. Third element of retail is we integrate mixed use into the bottom floor. And not a lot of folks were doing this when we got in the sector. We saw this coming from the better in breed cities in and around the Southeast that were passing zoning ordinances left and right. They were passing zoning ordinances for typically comp plan overlays or master plan overlays that had been enacted by the city council. And you can imagine for a city council or a mayor for that matter, self-storage is not exactly right. The welcome mat opportunity you're going to get. We don't create a lot of jobs, maybe one. We don't generate impact fees. We just have one bathroom typically. And we don't generate a lot of sales tax revenue because we just sell box and locks. So as a politician, we're not exactly great for the annual budget. So they have all, I shouldn't say, so many of the better markets. Charlotte, Mecklenburg County would be a great example. Miami, Broward County, Nashville, Tennessee, Richmond, Virginia, have passed these zoning ordinances that now stipulate that you're not going to do self-storage in my urban master plan overlay. And right, that's exactly where you want to be. That's where all the population that you want is. But you're not coming in unless you integrate mixed use into the bottom floor. And for us, what we do is we just integrate, typically we call it teaser retail, 1 or 2, 3 tenants possibly. These will be relationships that we've had for 20, 25 years. We've got 3 or 4 Starbucks in our legacy portfolio right now. We'll integrate those into the bottom floor. What it does is really changes the architecture. and it starts to look like, we call it neo-industrial, kind of that Starbucks look, and it makes the mayor and the city council more willing to approve. The best real-time case study I can share with you is we're in an incredible area in Nashville called the Nations, and it's where you've got so many young professionals that have flocked into this area. And it's got incredibly unique craft bars and restaurants and all the things, right, that age group looks for. Great parks, wonderful setting. But in that situation, we went in 3 times to the city council and got denied all 3 times. We came back in the 4th time with a mixed use presentation, and we had matched the architectural symmetry of our property with the architectural symmetry of the of the apartments next door. So they looked similar in scope. We got the approval. We sold the asset, certificate of occupancy, about 12 months later. So the last piece of what we do on the retail side, and bear with me, I'm rounding third base here, but the last piece is multi-channel, and it's absolutely, without a doubt, explained with Walmart as being the sample. In our world at Leitbox Storage Partners, we believe the best risk allocation is to do about 60% of our investment activity in greenfield development, where we're actually building an asset. 40% of our investment activity is in a mom and pop acquisition, so it's income producing, or we're converting possibly a FedEx building or possibly a dark grocery store. But if you think about the mindset of it, again, like retail, with a Walmart Supercenter, maybe development mixed use. If it doesn't work, maybe we'll do a Walmart neighborhood market. If it's something more appropriate, Sam's Club. The idea is that we don't just have one horse to ride. We have these different horses to ride where we match the investment opportunity to what the market will give us. And that's exactly what we believe in.
So it still amazes me that for all the investment merits of self-storage, you have an industry that's still largely mom and pop, and that these developers are doing one-off builds. So, I'm really impressed by the fact that you're really bringing an institutional quality or mindset to the industry.